The latest August jobs report has revealed a significant slowdown in job growth, raising concerns about the future of the economy. Only 142,000 jobs were added, falling well short of the 165,000 that experts had anticipated. This unexpected shortfall has caught the attention of economists and business leaders, prompting questions about the strength of the labor market. The data indicates a clear slowdown in hiring, which could have significant implications for the broader economy. Adding to the concerns, revised figures for June and July also showed fewer jobs added than initially reported, further dampening optimism. The average monthly job growth over the past 3 months now stands at a modest 116,000, a stark contrast to the more robust figures seen earlier in the year. This trend is particularly worrying for job seekers, who may find it increasingly difficult to secure employment in a tightening job market. Business leaders are also concerned, as slower hiring could impact consumer spending and overall economic growth. Economists are now debating whether this slowdown is a temporary blip or a sign of more persistent issues within the economy. Policymakers may need to consider new measures to stimulate job growth and ensure the economy remains on a stable footing. The health of the job market is crucial, not just for those seeking employment, but for the overall economic well-being of the country. As we move forward, all eyes will be on the upcoming job reports to see if this slowdown is an anomaly or the beginning of a more concerning trend. The next few months will be critical in determining the trajectory of the job market and the broader economy. The labor market has been on a declining trend for the past year. This decline is evident in the increasing number of closed businesses and the growing number of people searching for jobs. Many industries are struggling to maintain their workforce, leading to a significant reduction in job opportunities. Wage growth, however, tells a different story. Despite the overall decline in the labor market, wages have been steadily increasing. This rise in wages is a silver lining for many workers who have been facing economic uncertainty. Average hourly earnings increased by 0.4% in August, exceeding expectations. Financial analysts have been closely monitoring these trends, noting that the increase in wages is a positive sign for the economy. Employees in various sectors are beginning to see the benefits of this wage growth in their paychecks. This is likely due to employers needing to offer higher wages to attract and retain workers in a competitive market. With fewer job seekers available, companies are compelled to provide better compensation packages to fill their vacancies. This has led to a more competitive job market where skilled workers have the upper hand in salary negotiations. While this is good news for workers, it could contribute to inflation if prices rise too quickly. As workers have more disposable income, their spending power increases, which can drive up demand for goods and services. If supply cannot keep up with this increased demand, prices may rise, leading to inflation. The Federal Reserve will be closely monitoring wage growth as it considers its next move on interest rates. Economists and financial officials are analyzing the data to determine the best course of action. The balance between supporting wage growth and controlling inflation will be crucial in the coming months. The decisions made by the Federal Reserve will have significant implications for the overall economy and the financial well-being of workers and businesses alike. Adding to the complexity of the situation, the government recently admitted to overstating job growth figures for the past year. This admission has sent shockwaves through the economic community as analysts and economists scramble to reassess their models and forecasts. The implications of such a significant overstatement are far-reaching, affecting everything from policy decisions to market confidence. This revelation throws a wrench into the analysis of the current job market. Analysts who had previously been optimistic about the economic recovery are now forced to reconsider their positions. The discrepancy has led to a flurry of activity on trading floors, with traders reacting to the news with a mix of concern and confusion. The credibility of the data is now in question, and this uncertainty is causing ripples across various sectors. The overstatement, attributed to data collection errors, amounts to an overestimation of 88,000 jobs. This significant error has raised questions about the methods used in data collection and the reliability of the sources. Economists are now delving into the specifics of these errors, trying to understand how such a large discrepancy could have gone unnoticed for so long. The process of revising these figures is both time-consuming and complex. This means the actual job growth figures could be even lower than reported. The downward revision of job growth figures has serious implications for economic policy and business planning. Companies that were planning expansions based on the initial data may now need to reconsider their strategies. The revised figures paint a less rosy picture of the job market, which could influence everything from consumer confidence to investment decisions. The uncertainty surrounding the accuracy of the data makes it difficult to draw firm conclusions about the state of the labor market. With such a significant error in the reported figures, policymakers and business leaders are left in a state of limbo. The need for accurate and reliable data has never been more critical, as decisions made based on flawed data can have far-reaching consequences. Moving forward, there will be increased scrutiny on data collection methods and a push for greater transparency in reporting. The August jobs report, with its lower-than-expected job growth and data discrepancies, has sent ripples through the market. Investors are now anticipating a rate cut by the Federal Reserve on September 18th. This would be the first rate cut since 2020. The market's expectation of a rate cut is a clear signal that investors are concerned about the slowing economy. Section 5, the Fed's Balancing Act, stimulating growth versus controlling inflation. The Federal Reserve faces a delicate balancing act. Lowering interest rates can stimulate economic growth. It encourages borrowing and investment. However, it can also lead to inflation. The Fed must carefully weigh the risks and benefits of a rate cut. They need to find the right balance between supporting economic growth and keeping inflation in check. Section 6. Further signs of a weakening labor market. Beyond the headline job growth figures, other indicators suggest a weakening labor market. Job openings have plummeted to their lowest level since January. This indicates a decrease in employer demand for labor. Layoffs have also increased, reaching their highest point this year. These trends, combined with the slowing job growth, suggest that the labor market is losing momentum. Section 7. Unemployment rate in perspective. While the unemployment rate dipped slightly to 4.2% in August, this figure alone does not paint a complete picture of the job market. It's essential to consider the historical context. The unemployment rate has been significantly lower in recent decades. The current upward trend, coupled with other signs of a weakening labor market, warrants attention. Section 8. Interest rate cut sector-specific impacts. The Federal Reserve's decision on interest rates will have wide-ranging impacts. A rate cut could lead to a surge in stock prices as investors seek higher returns. It could also fuel a rise in home prices, potentially worsening affordability challenges. The impact will vary across different sectors of the economy. Section 9. Conclusion. Awaiting the Fed's decision. The August jobs report has painted a mixed picture of the U.S. economy. While the unemployment rate dipped, the slowdown in job growth and data discrepancies have raised concerns. The Federal Reserve's upcoming interest rate decision on September 18th will be a pivotal moment. Their decision will have significant implications for the U.S. economy.